our focus really is in the advanced planning area. Prior to founding my firm 8 years ago, I spent a decade traveling the country full-time, specifically consulting and teaching private wealth managers on how to invest for their high net worth clients. And I realized that much of the industry, unfortunately, doesn't focus on advanced planning, and that is why I started our firm.
Hey, Matt, Vance, he's part of that financial mafia there, Danielle DiMartino Booth, David Kotak, all those folks.
Camp Kotak.
That we know, so he goes to Camp Kotak, absolutely. Hey, Vance, I'd love to just kind of get your, we love talking to Danielle and Mr. Kotak, and kind of like to get their views. So when you go up there and you chat with those really smart folks about the markets, if you had to go up there today, what would your call be right now? Just in terms of the markets, the economy, how are you looking at things?
It would be the same call that I had a couple months ago when I was attending Camp Kotak, which was amazing because I have read and corresponded with these folks, and then to be a peer among them is just truly amazing. I'm in the higher for longer camp, which is an unpopular view.
Higher inflation, higher rates kind of
yes.
thing? Okay.
Yeah, very much so. And there's rationale to that. My view is that the economy changed during COVID, and there's this collective, palpable belief, not only among our clients, but also the investing public, that because of the interest rate raises vis-a-vis the Fed starting in March of 2022, that unemployment is going to spike and that we're going to have this recession and it's going to be horrible and that the Fed is going to cut rates back to zero, launch the printing press again. And I fundamentally disagree with that. During COVID, people age 55 and older were able to retire.
That's me, man.
Largely, hey, you know what? It's a pleasure to be here,
yeah,
right?
Right?
I'll get there
Exactly.
someday, I hope. I'm in no rush, by the way. But in any event, they were able to retire because of the largesse of their nest eggs, which was a product of the 13-year quantitative easing, zero interest rate policy era that we had. People 30 years of age and younger were able to move back in with mom and dad and go back to school. So how human beings behave has materially changed, and because of that, we have a different economy, if you will. If the Fed were to come out and cut rates now, my view is that it would reignite inflation and we would be in this sort of vicious cycle. So if we look at the real rate, which is interest rates minus inflation, we're at about 2.5. Over the last 5 decades, what has it been? About 2.5. So we believe that we're not going to see a precipitous drop, and that because of that, the investment landscape has in fact changed. But there's opportunity there.
What do you think about, Paul's been asking this allocation question. I heard the surveillance team talking about it this morning as well. 40-60, where we're supposed to see a comeback, and it seems like bonds and stocks are moving the same direction every day. How do you solve that problem?
Interestingly, cash is no longer trash because of the interest rate environment that we are currently in. Clients have come out and pointed out the fact that we can really have a great return stream in money markets and or T-bills. There's this funny term, T-bill and chill. And we were an early adopter to the T-bill trade, having largely blown out of bond mutual funds in December of 2021. So if you rewind back, the Fed, the White House, the Treasury were all saying inflation is transitory, inflation is transitory, and inflation is transitory. When you hear that messaging consistently over multiple months, yet the inflation data keep increasing, maybe, just maybe, it's not transitory. And we all know the rest of that story. When we look at the correlation between equities and fixed income, it is important to diversify, but we have to go back to the pre-COVID era playbook and understand how to deploy across equities and fixed income and real estate and so forth. So given the interest rate environment, we think we're pretty close to the Fed largely being done. That creates an opportunity for getting back into specific types of duration, whether it's individual issues or some bond funds or even potentially ETFs. Regardless, we're going to be long duration here in the next 3 to 6 months, depending on how it plays out.
All right, so we sit back here and we've got a Fed that I guess we're high. I'm in the camp that's just kind of high for longer, and I think eventually they're going to cut because I need to refinance my mortgage I just took out. When you talk to clients, one of the things I hear a lot when talking to private wealth is family offices and kind of just tax planning and estate planning. I mean, do people get that right yet? I mean, do people you talk to, are they savvy enough to kind of deal with that?
No, and having spent thousands of hours inside of wealth management firms and with financial advisors for a decade, that was my largest observation. There's a huge generational shift in terms of asset transfer that's going to happen from the boomers to largely Gen X, but also millennials. And people like to make jokes about millennials, but let me tell you, they're a very purpose-driven cohort. They're really smart. They grew up with technology. They really don't need to have help selecting ETFs. The real alpha, if you will, is in the advice idiosyncratic to the family. And my cry to the wealth management industry is to bring maximum value by way of incorporating true tax planning. For example, a financial advisor cannot bring maximum value to a family unless they are literally looking through and analyzing the tax returns. I liken it to this. If a client has ever been to a medical specialist, what's the first thing they ask for? The general health history from the GP. Well, I need that. I need the equivalent of that, which is the last 3 to 5 years of tax returns, so that I can look for different planning opportunities. Big planning cliff coming up, which is the sunsetting of the Tax Cuts and Jobs Act. And that will happen December 31st of 2025. We're going to blink. It's going to be here. But the current estate tax threshold will be cut in half. So the largest underserved cohort in the wealth management industry is that $1 million to $25 million liquid profile. Why? Because many of the retail financial advisors, and I'm talking old guard retail financial advisors, don't have the advanced planning technical expertise and acumen to understand certain things like idiots and islets and grots and different types of grantor trusts and so forth. And if you're one with a really high level money problem, which is having 25 million liquid, a lot of the private wealth firms don't focus on you because their minimum is 50 million and above. And these are big numbers, right?
Yep.
But there's a huge opportunity, and one of the great things about Commonwealth is that there's a big push for the advanced planning area with respect to bringing maximum value.